Okie dokie. So day 2 of the bootcamp. Once again, thank you all for taking your time out to be here. For those of you that missed yesterday, the recording is up. It has been sent to your email that you registered with. There is a YouTube link in there. It's unlisted, therefore not the public cannot view the recording. That recording will only be made available to the public in a couple of weeks, just to be fair to everyone who signed up on time. And today is going to be a deep dive on some technicals and behavioral finance. For most of you that don't know, my expertise over the years have really developed into behavioral finance because it's something that I'm passionate about. And when I was going through my bachelor's and master's in finance, I actually reached out to a bunch of my professors to see if I could work under them to study this field further. And then a lot of them forwarded me on to their counterparts or their alumni, and I got a lot of opportunities to study this field. And also, for those of you that don't know, I intend to do my PhD in behavioral finance in the future. Now, when that may happen, I don't know. It's going to be a while, but that's a field that I want to study. So let's deep dive straight into it. And let's talk about how your brain works for a second. Because when we talk about brain chemistry, it is a very intricate piece of technology that exists. And I like to take this playbook straight from Daniel Kahneman, because it wasn't Kahneman who popularized or theorized this. It was another philosopher who theorized this, but Kahneman did the deep work along with Amos Tversky, who really pioneered this field, okay? For those of you that are unaware, Daniel Kahneman passed away about 3 days ago. He was 90 years old when he passed away, but he's made some very substantial commitments to the field of behavioral economics and behavioral finance, which is a study of how interactions happen for humans with relations to money, with relations to anything to do with monetary or opportunity cost. And a lot of you, correct me if I'm wrong, but a lot of you are suffering from severe loss aversion, right? And we're going to go through loss aversion today because I briefly went through it yesterday, but I didn't really do a deep dive. Now, another thing that I want to mention right off the bat before we continue on this beautiful bootcamp today is we're going to be playing a game, okay? At any given time, I'm going to touch my nose. And the last person to turn on their video and touch their nose is going to tell us a secret. Okay. It could be any secret, but essentially I want to try and get you guys warmed up to actually, kind of be on video, be a part of this conversation. I would love to see your beautiful faces. It makes it more engaging for me, like as though I'm not talking to a wall. I can see beautiful Peter here and how he's reacting to everything that I'm saying, right? It would be nice to see a couple of you and feel like I'm actually talking to a group of people. And once again, hi, Jonathan, what's up? And once again, as I said yesterday, it's really, really imperative that you engage with the sessions, okay? So right before I start, I just want to make this point very clear. For those of you that missed it yesterday, when you engage, you are actively using system 2. I'm going to show you why, okay? So let's talk about it. Your brain breaks down into 2 separate processes. This was studied by Daniel Kahneman and Amos Tversky, okay? Now, system 1 is a swift, ready, and passive system. This is the system that draws very quick correlations, okay? So your brain works in 2 ways. There's system 1 and there's a system 2, okay? Now, system 1, an example of system 1 would be, I smell roses, therefore I think that of a rose, okay? Or I see the color red and I automatically link it to blood. It's a very passive system. It draws on your previous past experiences. It draws on what you already know, right? And it draws on a lot of your already present memories, okay? So it relies on your available information to facilitate quick decision-making, all right? And what happens here is that it often contributes to impulsive decision-making, pursuit of past successes, and impulsiveness, okay? So when you are looking at a trading chart, for example, you might be using the past
For the plotter.
Sorry about that. You may be using your past to look at a chart and say, oh, Tesla has been here before, therefore it can do this again. Now, this is where the birth of cognitive biases come into play. Okay, where does it stem from? It stems from the fact that you are using something from the past, or a past memory, or a past experience, and you're extrapolating it. You are now projecting it into the future. Okay, it might not be true, right? So the cognitive bias can result in a few things. One, overconfidence. We know this is a very common one, right? Framing effects, where you frame a specific idea and you think that that idea is going to be the main theme for the rest of your ideas. So you frame everything in the same window. And then loss aversion, which is a severe reaction to how you view your losses and gains. Okay. Now, on the other hand, you have system 2. And system 2 is slow, it's logical, it's intentional. It prioritizes deliberation, and it demands effort, attention to make the decisions, right? So when system 2 is applied, right, it allows one to carefully evaluate risk-reward scenarios, accept different outcomes because you are intentional, and at the same time, it rewards rationality. So I wanted to leave a little quote here, which honestly is probably one of the best quotes that Daniel Kahneman has wrote, right? He says, the best we can do is compromise. Learn to recognize situations in which mistakes are likely and try harder to avoid significant mistakes when the stakes are high. This is a very direct, correlated statement to how many people usually go the other way in trading. Because of their lack of compromise within themselves and moving from the theme of yesterday, which was the ego, right? You're not able to compromise with your ego. What happens is that you try harder to overcome those things rather than accept it. And out of trying to overcome those things, you put yourself in a deeper doo-doo, right? How does everyone feel so far? Do you understand everything from this slide? So these are the two systems that operate, okay? Your brain is hardwired to behave like this, okay? This is a behavioral thing. You can't change it. You can only know about it, and you can only keep yourself informed about it. So now, what are some complications that arise from using system 1 too often, right? Because we are aware that system 2 is the preferred system that we should be working with as a trader, correct? Right? Between system 1 and 2, we want to less use this system and we want to more use this system. We want to be intentional, slow, logical, not trigger happy, fast, and impulsive, right? Because when you're calculated, then you make better decisions, right? Well, here are some of the problems that system 1 causes. Here are some of the biases that arise when you're using system 1 and you simply don't realize it. Which system is intuitive? It's the system 1. So the first one that arises is overconfidence, right? This is when someone overestimates their understanding of a specific outcome, disregarding data or analytical insight. Now, this is a very common theme you will see among gurus, right? People who are trying to become a thought leader, but they aren't really truly a thought leader. They're just perpetuating other data that they may have seen elsewhere. And then other retail traders start to follow this person because they are perpetuating that data. And what happens is you get a vicious effect in which people follow that person into the abyss, right? And what is the cause of this? The cause of this is overstimulation and general, but not deep knowledge, right? Anybody can tell you how price action works. But can someone actually really deep dive into it, explain exactly what happens? Only a true academic scholar or somebody who studied the field in totality can give you those answers, right? I'm throwing up examples here. This is not to throw shade on anybody at all, right? I'm just giving you examples, right? And the remedy for overconfidence is perspective, right? You need to have perspective. You need to have prudence. What is prudence? Prudence is the ability to make decisions in a slightly balanced risk way, balanced risk to reward adjusted way, right? And retrospection, which is to have the ability to introspect or sorry, not to introspect, but to look at the past and see what has happened and act on your past experiences, right? So these are some of the things that overconfidence causes. Okay. Who suffers from overconfidence here? Put your hands up. Even I do sometimes. By the way, out of these 6, I'll tell you which ones that I suffer from, right? I'm going to be sharing all this information with you guys. Listen, there are no secrets here. I don't have any, like ego barrier here to be like, oh no, I'm perfect human. I have never suffered from any of these. No, it's not true. I suffer from some of these, right? Nobody? Seriously? There's nobody here who suffers from overconfidence?
Not as much as I used to.
Wow, that is very interesting. Okay. Okay, which brings me also very quickly, those of you that want to be a part of this beautiful stage over here, I would love if you turned on your webcam. It would be nice. Just saying. I would love to see your beautiful faces. Okay, loss aversion. Next one. This is the main one, right? I think as a trader, this is the one that affects you the most. Okay. This is when one feels the pain of loss more strongly than the pleasure of equivalent gain, resulting in a greater loss. And when I say resulting in a greater loss, we are talking about opportunity cost here. Okay, we're talking about opportunity cost. So not always is a loss an implied loss from the get-go. When we are talking about losses, they can be implicit or explicit, right? And when we say implicit or explicit, we mean they can be potential loss or real loss, right? So I'll give you an example. You bought Bitcoin at $5,000, right? And it rallied all the way to $15,000, okay? So Bitcoin goes from $5,000 to $15,000. You're like, wow, that's amazing, right? But then the next day, it drops from $15,000 back to $5,000. Now, how do you feel? Do you realize that the emotion you feel in both scenarios are different? If you don't, then you don't suffer from loss aversion. But if you do, then you suffer from loss aversion, because what happens here is the perceived loss causes you more pain than the actual loss. You've not closed out the trade, but you feel that loss, right? And so the issue here is that your opportunity cost perception is warped. You do not know how to measure opportunity cost. And I don't blame people for this, because not everybody has a general understanding of opportunity cost, right? Like, if a investment had the possibility of making you $20,000 and it's went up to 10 and went down to 5, right? Then your opportunity cost is much higher there, because the perceived gain is higher, right? So the loss aversion is caused by a severe perception of what you think is the right amount that you should win or lose, okay? And this is a very big problem for most people. I think by far, among all of these cognitive biases that I'm about to share with you, the loss aversion is the one that affects traders the most, okay? So how do you remedy loss aversion? Now, personally, based on my own experience, and by the way, I suffer from loss aversion, right? I think I do, but it's not exaggerated, but it is there, right? I know I do, because sometimes you take a trade, it goes up into where you want to take a profit, and then very shortly after that, it goes into a loss, right? And then you close out the trade at a loss, and then what happens? It reverses against you and goes higher, right? And how do you feel? You feel shitty. That's loss aversion, right? So if you have ever felt that before, put your hand up. All right, let me know if you suffered from that before, right? I have. This is a very common one. So the only way to remedy this is to create rules of engagement. and checklists. This is what I found to be the best way to tackle this. The reason why you suffer from loss aversion is because whereas there is a very highly likely chance that you have moved the goalpost. You guys get what I mean? You had a plan initially, right? You initially had a plan. It was a great plan. And then you changed that plan, right? And because you changed that plan, now your perception of the plan is different, right? Your opportunity cost is different. So because you changed your plan, now the outcome is different, and you're not happy with the outcome of the new plan after you've changed it. You guys get it? You guys understand, right? So this is the reason why loss aversion happens. And the best way to avoid it is to write a list of things that you have to do. This needs to happen for me to do this. This needs to happen. So we're going to be doing it tomorrow, right? Together. We're going to be doing one of them. We're going to be doing a trading checklist, right? And obviously at the end of today's meeting, I want to get a good show of hands on what kind of a checklist you want to build. Or we could do that tomorrow as well. It doesn't really matter that much. But tomorrow we will be getting that checklist done. And so you'll have at least one of them, right? So this is a good way to tackle loss aversion. Next one, anchoring. This is when, and I know that you're all going to start laughing with this one because, you know, this one's too real, right? I think a lot also suffer from this one. And this is also one of the ones that you see go crazy on the Twitter space, right? Or now called X, right? So this is when one relies too much on pre-existing information when making decisions, influencing future decisions, right? And this is caused by what? Over-reliance on the current information or outlets. People think the more information I have,
Come on, dude.
So what happens is that they over follow too many people, or they are constantly looking out for other outlets to follow in the idea that they want a different perspective. But what happens? You get crowded, you get decision paralysis, and then you develop something called anchoring, which is where now you have an anchor, and this anchor messes with your judgment. So let me give you an example. You go to a store and you are trying to purchase a t-shirt. Okay, say you want to go t-shirt shopping, right? Or a shirt for that matter, or a dress for that matter, right? Okay, whatever it is. And what happens here is you see the first item, you see the first one, and it costs you $1,000. Okay, and you're like, okay, you know what? I'm gonna go look at the other store, right? And you walk down the street, you find another store, and this store is selling another similar shirt or dress or a t-shirt for $100. Now, immediately your first impulse, which is a bias, is this is cheaper, right? But is it truly? The reason why this happens is because of the $1,000 anchor. The anchor was planted in your head in the first instance that the t-shirt should cost $1,000. And therefore, when you go to see the second t-shirt and it's $100, your comparison is this is cheaper. But in reality, maybe the t-shirt only costs $10, right? So the reason why this affects you in trading is because you may use a past situation and you anchor it so strongly that the future decision suffers because of it, right? For example, people would think like, oh man, Tesla was trading at around, you know, $300-400 when it was 2021 peak, right? And that was when Tesla was expensive. And now Tesla is cheap, right? Because it's trading at sub $200, right? But remember, here, the anchor is the past price of Tesla. And your decision should not be based on the price. Your decision should be based on independent analysis. So how do you remedy this bias? You have to allocate unbiased independent analysis. You have to allocate time for it. Okay? That means you have to do the work. Yes, you have to do the work. There is no free lunch in this world, right? You want something, you have to do it. You want to find the truth, you have to find it yourself. Don't rely on others. Okay. So that's your anchoring. Next, Okay, so by the way, I don't suffer from anchoring. That's one of the ones that I don't suffer from because I'm very, very, like, people know this about me. I don't care about what other people think. I really don't. I will go against the grain most of the time. Being a contrarian to me is actually one of the most freeing things because taking the contrarian trade makes me feel very liberated. Even if I'm wrong, I don't care. I'd rather be wrong, but it's my own idea, than be right and follow somebody else's. Because then at that moment, you know what happens? Your ego is bruised. Because you feel stupid for being wrong by following others, right? You feel like, man, now you start blaming the other person. You shift the blame, right? So initially it's your problem. It's a problem. Why? Because you follow the other person's methodology, right? And then you're like, oh man, I shouldn't have followed this person, right? You start blaming that person, but actually who's at fault? It's you. So your ego is bruised. What happens? Your ego comes out to defend you. You're like, no, it was this, it was that. No, the market was this. The Jerome Powell came on to speak. You come up with 15 different reasons as to why that trade went wrong. But in reality, we all know who's wrong. It's you, right? It's you and me, both of us, right? So this is one of the problems that you got to fix. Next one, confirmation bias. This is a big one too, right? When someone seeks information that supports only their beliefs and hypes themselves up along with others. This is a very common one you will see among gurus, right? The Twitter sphere is full of them. The Instagram is full of them. Everyone's the whole trading community is full of them. And this is the kind of toxic shit that I try to avoid, right? And what is the cause of this? This is a cause of overstimulation and hyperfixation. I also wanted to add a third thing in here, but I decided not to. But that's also ego stroking. You want to stroke your own ego, right? What does a situation like this sound like? It's where you believe in an idea so much that you share it so often, trying to convince other people to jump on it, right? And it's just really bad for you because what's going to happen is there's a difference between sharing an idea once or sharing an idea over and over and over again and proving to somebody that this is what is going to happen. And then when it fails, you switch and you bait and you go another way and you try to still prove yourself that you're right. The problem with this is it causes a very deep sense of insecurity. It's the opposite of what it's supposed to do. Because you are constantly trying to prove yourself, you become insecure. So your confidence and self-esteem craters. It completely shatters, right? As an effect of this. This is the reason why a lot of people they feel the need to prove themselves when actually there's nothing to prove yourself in trades by charting or this or that. The P&L speaks for itself, right? Trading is one of those professions where the outcomes are very simple. Your profit and loss is what speaks, nothing else, right? So the overstimulation and hyperfixation on something causes you low self-esteem and it causes you a lower confidence level. This is something that you need to be aware of. And what is the remedy? Keep your damn opinions to yourself, right? You can share it, but don't like keep sharing it over and over again every day, right? That's not going to bring you anywhere, right? And another way is research the opposite idea. You've given the research about one particular outcome, but what about the other, right? That's how you avoid confirmation bias. Do you realize whenever we talk about different trading outcomes in Discord or live trading sessions, right? How do we discuss it? We never ever use a bias, right? We always talk about the fact that you should be prepared to go either direction. That's your job as a trader. Your job as a trader is not to predict whether the market's going up or down. That is not your job. Your job is to predict how you can take advantage of both those scenarios, right? So prepare both outcomes and then your confirmation bias fades away, right? Next, hindsight bias. This is when someone becomes convinced that they predicted something before an event occurred, leading to overconfidence. And this comes from the need of someone to stroke their ego and prove their worth. When actually the effect of this is the exact opposite. Because they have such a shattered and bruised ego, they have low self-esteem and lower confidence, therefore being in a vicious trap cycle where they need to keep proving themselves, right? This is just, I mean, I'm not really sure why this one specifically happens, but it's more of a behavioral thing, that's for sure, right? It's a personality thing. Now, the remedy for this is you need to journal your ideas and review your journal. This comes from introspection. This doesn't come from an external source. It doesn't come from something that you can do. It's a work that you have to do deep within. This is actually one of the more difficult cognitive biases because it cannot be just remedied very easily. Now, upon reviewing your journal and journaling, what happens is you start to see where did I go right and where did I go wrong? And then you have a realization, hopefully, at some moment that maybe I shouldn't have done this or said this or, embarked on this like this. And then the last one. So from here, I will say, I think sometimes I have the capability to probably have 10% of confirmation bias. I would admit that about myself. Hindsight bias is not something that I honestly, feel like I go through. I don't overly mention something that I had predicted. I will mention it once at most, and I'll be like, "Hey, remember when I told you guys that Coinbase was gonna triple up?" Which I did, and then that will be the end of it, right? I don't use it to stroke my ego because I just want to make it known that this was something that I told you guys, and look at where it is now. You could have made stupid money on it, right? And the last one is recency bias. This is when someone believes strongly that recent events will occur again soon. In other words, your doomsday predictors, and almost 70% of the market probably falls within this category. This causes irrationality and ultimately poor decisions, because what happens is someone believes in the idea so strongly that they dare to assign a huge risk to it. Now, the thing about this bias is when you combine it with other biases, oh boy, it becomes a big problem, right? When you combine recency bias with confirmation bias, just think about what happens there, right? That's a big problem. So here, what happens is you're consuming too much news, you're relying on others, and it's causing a big issue in terms of your perception. Your perception is warped. What's the remedy? Stay in your own lane, right? Stay in your own damn lane. Focus on your own outcomes. Focus on your own work. Stop looking at other people. Stop looking at what other people are talking about. Look at what the market telling you from your perspective. Stop relying on somebody else's perspective, right? It's good to listen to opinions, but don't overly rely on them, okay? Last two. The sunk cost fallacy. How many of y'all have suffered from this? Oh, by the way, very quickly, sorry, right before I continue. How many of you suffer from any one of these? Tell me which one you suffer from. Oh, Peter, I think your mic's off.
Sorry, yeah. Confirmation bias. It's sneaky. Sometimes it just creeps its way in and you don't realize it in the moment a lot of the time.
Yeah, I agree. I think I'm in the same position as you.
For me, I would say it's recency, because it's a mix of like having so much information that would be hard for me to actually come up with what might happen.
Yeah.
And then I would look for other people, oh, what do they think about this or whatever.
Yeah, that's I can sympathize with that. Because I think what happens is sometimes it's not our fault too, right, guys? The issue is we're not always well equipped with the ability to come up with the information that we need. And so therefore we rely on other sources who we think are credible, right? And then these credible sources, unfortunately, are relying on other credible sources. And so it's a game of telephone that sometimes goes bad. So the only way to break this cycle is to do it yourself. And once again, how does this break the cycle? Because initially what happens is when something goes wrong, you start to shift the blame to the source that you are following from, right? It falls back to the same thing as confirmation bias. And when what you should be doing is blaming yourself. because you are the problem. It's not that person who is the problem. You followed that person's opinion or result, right? And that person is following another person. So the only way you break the cycle is if you follow your own damn opinion, right? Follow your own path, and then you see the things start to change. Okay. Last two, and I think that these two will hit a lot of people, and I'm sorry in advance, but like this one, it's pretty bad, right? The sunk cost fallacy and herd mentality. These are two of the most common ones. Sunk cost fallacy first. When one justifies throwing more money at an opportunity that keeps getting worse by justifying how much they have already put in to begin with. Hands up if you've done this. I have definitely done this before, right? When I was in my start of my trading career. What happens here? You put $1,000 into a trade, you think it's gonna go well, it goes down to 500 bucks. You put another $500 in, thinking I'm gonna double down, and then I'm gonna make my money back, right? Sometimes it works out, and that's where it gets dangerous, right? And then when it works on it, and then you get your money back, you're like, well, this is a proven method. I can do it again. And then what happens there? Confirmation bias. You see how the different biases intermingle with one another. It is like a many-headed freaking hydra or a serpent, right? You chop one off, another head appears. You chop one off, another two appears, right? You are fighting so many things inside your head to succeed through your trading session. This is the reason why you need structure. This is the reason why you need to have a plan, right? And you don't deviate from the plan. The problem is when you deviate from the plan. And when you have a plan, you deviate from the plan, that is going to put you in hot soup too, right? So sunk cost fallacy, what happens here? Why do you go through this? It's because your risk sizing is way off. Okay, it's a very simple determination here. You initially took on too much risk. Then now, because the risk was too big, what has happened? You move the goalpost, right? You move the goalpost here. What do? You said, man, I risked too much on this trade. I cannot lose this much. This is too much for me. And what happens? I need to put more in to make it back. And then what happens? You lose that too. And then what happens? You put more. And why do you put in more? Because you justify the fact that you put in that much. You damn near crazy, right? And we have all done this. I'm just poking fun, obviously, but this is what typically happens, right? All of us have been through this. There's not one person here who has not done this, right? I can safely say that. This is a painful one. Now, what is the remedy? Respect the damn stop loss. If you have a risk assignment, stick to it. The moment you move the goalpost, understand something. You are opening yourself up to additional risk for very little reward. Sometimes it might work out, but remember the chances of it working out versus not working out is very slim because you have a plan. You remember, you theorized the plan in your head, you marked it out on your chart, you examined where the supply and demand was, you examined where the market dealer exposure was, where the gamma was, where the delta was, you examined where the indices were. Everything is in plan. And then the moment that you put in your risk, all of a sudden something changes. Why? Because your conviction is higher. It doesn't work like that, right? And obviously, I'm telling you this in hindsight because I have been through this over 11 years. So I'm sharing this knowledge with you from the perspective that please don't do this, right? So the only way around this is control your risk. Your damn stop loss has to be in play. If you take a trade and it doesn't have a stop loss, ask yourself why you're taking that trade. Immediately stop and ask yourself why you're taking that trade, right? You have to have a risk tolerance. You have to have a rule in place. Okay. Last one. Herd mentality. When I first started trading, I suffered from this. Now, not at all, right? But I did. So I am guilty of this. Sunk cost fallacy and this for sure. I raised my hand 10 times because I've been through this as a beginner, right? Now, this is when one copies others' methods instead of doing something on their own, and then they expect the same results. It's purely emotionally influenced. And then the problem is, really hate this part of finance. And I'm going to be really openly talking about this because I think that this is something that it enrages me, right? It's the fact that people know that this bias exists and they prey on people who suffer from these biases, right? What an example of this? I go take a picture with my quick Lamborghini out there, right? And then I post that I'm a great trader, right? And then I expect other people to join my posse expecting the same results, right? And this is a very simple example, but you get the idea. Some people lead others down a very dangerous path by flexing their wealth, by flexing their materials, by flexing their whatever it is that they own, possessions, right? And other people think that they can achieve the same results just because that person is rich and because they will listen to them. When you don't realize that there's got to be so much of additional work that goes in there. You want to listen to people who are rich from mindset, not rich from riches. Mindset rich is a different kind of success, okay? Gives you a different kind of freedom in life. And remember that at the end of the day, if your aim in life is to accumulate material possessions, there's nothing wrong with that. But might I implore you to rethink your aim in life? Because I think if you are looking for material possessions, then what you are truly looking for is freedom, not material possessions, right? So you need to be aware of this. Now, what happened? What is the cause of herd mentality? The problem is this. It's the path of least work. It's laziness. This is what drives it, right? I think that this person is successful because they have a Ferrari, they have a yacht, they have a nice house, they have a very nice possessions, I don't know, whatever it is, right? Therefore, I want to follow this person's path and follow exactly what they're saying because I want the same effect. When you're living a completely different life, right? You're expecting the same results. It's not going to be possible, right? The remedy to this is don't be afraid to be a contrarian, right? But be a contrarian with reason as well. There's a balance here. Don't oppose to oppose. Oppose with reason. Do something different with reason. See, you don't want to go from here to here. You don't go the opposite direction. Your aim is to find a balance. Okay? So don't follow blindly. You can keep them in your orbit if you want, but don't listen to them, right? That's what I'm trying to say. Okay. So out of these two, I think we can safely say that we have all suffered it in some way or some form, right? So how do we control these biases? I've broken them down into 4 simple things. Really, really simple things, okay? It doesn't have to be complicated. Number 1, use a system and don't deviate from it. You need to have a process, okay? That means your system is, I wake up in the morning, I'm going to do this. It has to be a checklist of things. I have developed that checklist to the point now where it's second nature. I don't need it written down. It's already a part of me, right? But if you're new into this space, you need it written down. You need it pasted in front of your screen so that you can follow that checklist for a little while. And you know, what they say, 3 months to make a habit, correct? After 3 months, you won't even need that list, right? So it's baby steps, one day at a time, follow the rules of engagement and don't deviate from it. Here is one thing about deviating from your rules. The moment you change what you do as rules, then your outcomes start to get deviated too, okay? So you need to be aware of this. You cannot change the rules. The moment you change the rules, then the solution is going to change as well. Sorry, Alex, did you have a question? Your hand was raised. Just checking. Next one. 2-strike rule. Everybody in Discord knows this. I make 2 wins or 2 losses, I stop for the day. There is no way around it, right? I will not trade myself into oblivion. The moment that I have either 2 wins or 2 losses, I'm done. There's nothing else to do for the day, right? What am I going to do? Sit there and expect something to change? No. If you have already hit your risk assignment for the day, that is it. You walk away, right? Nothing else. This is a very simple rule. What it does is it will reset your emotions. Okay, very simple rule. You walk away not because you don't want to be tempted. It's because your emotions are now operating differently. When you take 2 losses consecutively, what happens? You're suffering from severe loss aversion at that moment. When you're taking 2 gains, what happens? You're suffering from overconfidence at that stage. So what do you need to do? You need to come back to baseline. How do you come back from baseline? You do other tasks in the entire day. You come back the next day, right? Because your emotions are not going to go back to normal within 15 minutes. Anybody who tells you that, I don't know what to say. Your brain chemistry, unless you're a superhuman or you have very control, like good control of your emotions, then you can tell me, I'm going to take a 5-minute walk and come back and then continue this. And suddenly your emotions are different. I mean, that's got to be something wrong there, right? You need time. Your brain chemistry needs time to adjust. And more importantly, you need time to introspect. You need time to look at the situation and be like, I fucked up here. I did this well. What do I need to fix? Right? So because you are in such a heightened emotional state, you are likely to make stupid decisions, and that's what we don't want. Third, when in doubt, lower your risk size. You feel iffy about a specific setup. You don't feel it's right. You feel like, you know what, I took this, but I don't really like it. Cut your risk off. There is no shame in cutting risk off the table. Going smaller and losing smaller is better than going bigger and losing bigger. Right? And the last one, identify your triggers and respect them. Now, I don't know if many of you know this, but humans have triggers. Some of you might not even realize that you have triggers. There are certain things that might happen during the trading day that are not even trading related, guys. Let me give you an example. Your wife wakes up or your husband wakes up and he ain't happy or she ain't happy. They say something out of pocket to you. That affects your mood before you get into your trading session. All of a sudden, you are triggered. Your emotions are heightened. And now it sets you into a irregular trading session. This is one example. Another example, you didn't sleep well. You woke up tired, right? You don't feel 100%, but you are still pushing through the session because you have convinced yourself that sitting in front of the screen for 3 hours is contributing to your future more than you taking the day off. And I'm going to tell you that that's actually doing you worse. This will be very contrary to popular belief. People will say, no matter what happens in the day, you got to put in the time, you got to put in the work, you got to put in the hours, that 10,000 hour rule, right? No, when the days you're not feeling good, you're simply not feeling good. You take the day off, right? Trading is the one profession where you have what? Freedom. You have the freedom to do whatever you want. And you're trying to tell me that when the time comes and you know something is off, you're still going to press it? That's not going to bring you anywhere, right? So when you feel something's off and you know you're getting triggered, your emotions are off, right? You know when you're getting triggered, right? Somebody says something to you and all of a sudden you feel angry or you feel disappointed or you feel sad or you feel lonely or you feel anxious. Any one of those emotions, just take a step back and assess it, right? And respect it. Don't go against it, because if you go against it, what are you doing again? From day one, you're letting your ego come into play, right? What happens when, let's say you feel anxious, right? Or let's say you feel angry or disappointed in the start of your day for whatever reason, okay? Whatever reason it is. And at that moment, you decide, you know what? I'm going to fight through this. I'm going to fight through this and I'm going to go through my trading session anyway. What's happening here? Who are you trying to prove? You're trying to prove yourself, right? And what are you trying to prove yourself? You're trying to prove yourself that you can get through this. When in reality, you know that there's a high chance that you won't. So your ego comes into play here, and that's what I'm trying to tell you. Avoid this, okay? Avoid it at all costs. So when traders make trades and win, they tend to focus on the growth of their accounts, right? Oh, I'm up 50%. Oh, I'm up 100%. Let's take this higher. Let's fucking go, right? That's the common saying. And when this happens, what happens here? It creates a pretense of overconfidence that the trader is running hot. It's like you're entering the casino, you're gambling now. You feel like you're on a roll, nothing can go wrong, right? And what happens in this case? If the trader does not practice proper risk management, then you increase your size of your bets. And what happens here? You conversely end up losing more money, because as the more number of trades you take, you don't have proper risk management. What happens? Your natural risk reward ratio is going to be thrown off, right? Coming in from day one, as we discussed yesterday, your high win rate doesn't mean jack shit. You tell me you have a 90% win rate, good for you. That doesn't mean that you're profitable, right? It's how the risk to reward ratio outcomes of your trades are. That's what makes you profitable, right? So you have to control this. So here are some important facts to focus on. Focus on facts, not news, not stories. And when I say we, I mean you and me. We know less than we think we do. There are whole industries built on predicating information. Hedge funds and mutual funds and big banks, investment banks, they spend hundreds of millions of dollars a year conducting research. So humble yourself a little bit and don't act like you know everything. We are in a lifelong journey for learning here when you're a trader, okay? Commit to the lifelong journey, okay? And statistics plays a big role. Consider the odds of an event happening before you get onto this stage. If you are not able to understand the odds of an event happening, you're going to put yourself into really big doo-doo. Because if you put your finger up in the air and say, oh, you know what, today is a Sunday or a Saturday, and I feel like SPY might go up, or I feel like SPY might go down. If you feel very strongly, you're immediately off, right? You're not engaging system. What system are you not engaging? If you feel. Two. Right? That's right. So remember, you need to engage system 2, right? System 2 is the most important thing. Engage it, feel it, be intentional with what you're doing, okay? And then number 3, obviously, this one you've probably heard a million times. Sell your losers quickly and ride your winners longer. Where does this stem from? Where does this phrase stem from? Have you guys ever wondered? This is such a common trading phrase. Where does it come from? You do realize this comes from loss aversion, right? Because if you practice this, that is literally the definition of loss aversion, right? By avoiding loss aversion, what are you doing? You are cutting your losers short, and then you are letting your winners run longer, right? We're going to talk about how to do this, by the way. This is not just words coming out of my mouth. Let's also put action to it, right? So I will show you how this is going to work out. Today itself, you're going to learn about this, right? I wanted to focus on loss aversion today because I think it's something that affects everyone disproportionately. And the last one, obviously, don't value something more just because you own it. This is a very typical problem, right? I own Apple shares, so then I go around telling everybody you should buy Apple. The moment you catch yourself doing this, check yourself. Because this is a dangerous damn path you're walking on, right? Like the moment you start telling yourself like, oh, you know, I should tell people about this good, great investment. No, that's not your job. You want to share both sides of it. Don't share one side. If you're sharing investment advice with your friends and family, make sure you tell them, this is why it's good, this is why it's bad. That makes you a balanced person. But if you're going to go ahead and say, you should buy Tesla because of this, and then you don't mention that it's a risky investment, or that the fact that it can go from $400 to $100 in a year, you're not being forthright. And you're not being honest with yourself, right? So be careful of that. Okay. This is where we're going to do TradingView. Quickly, how's everyone doing? Everyone went quiet for a little while, snapped back into reality. Oop, there goes gravity. Oop, there goes rabbit. He chokes and no. Yeah, the M&M song. Okay, I'm just gonna stop singing now. How's everyone doing? We just went through a massive psychological revelation. I hope that you guys feel revealed. Some light has been shined on you, and I hope the heavens bless you with all this knowledge, and you take it to the highest power to get the best outcomes. Some of these things are not easy to get through. I want you to, at this moment, for a minute, contemplate the amount of things that are working against you just in your own head when you're going through a trading session, right? And so this is the reason why structure is important, okay? And that's what I have been building over the years, is structure. The reason why people come to Timeless Finance now, or EGA as it used to be, or why people seek me for mentorship or seek me over other people, is because of the structure, right? Structure provides everything. Accountability is the other thing, right? So we're going to talk about TradingView now. So Does anybody need a break? Does anybody need short break or 2-minute break? Use toilet, get water, anything like that? Or should I press on into TradingView? Alrighty. Proceeding. Yes, sir. All right. Now, I know most of you, use TradingView quite frequently for charting. Great software. I want to show you how do you use it intentionally. Okay. Now, first things first, let's go through some like housekeeping stuff, I like to call it, because there are a specific few things that you can do that are going to make your life much easier. Okay. Now, everybody has their own style with setups. Okay, so we're not going to get into individualistic setups. I just only want to teach you how do you use TradingView to your advantage when you are a trader that is looking for specific help. Okay, first things first, let's start with the time frames. Okay, I'm not sure if you are aware, but if you have TradingView Pro, you can have these time frames selected with the star, and they will all appear up here as to what you want. Now, everybody has different time frames. We have an account that has 5 people, so we have various time frames that accommodate to everyone. Now, for example, 3 minutes is a scalping time frame. 5 minutes is a scalping time frame too, but then it's more for trend analysis within scalping. 10 minutes is the ideal time frame for intraday trading. 15 minutes is for intraday trend analysis. 1 hour is for intermediate time frame, right? And 4 hours is for intermediate time frame analysis, right? Daily and weekly, the same thing. Monthly for macro. This is where you are looking at historical prices, right? So you need, if you wanted to put more than one time frame, you can. Okay, just putting it out there. You can even add a custom interval if you wanted. Okay, some people do all kinds of jazzy stuff. I know I've heard of something called 65-minute charts. Am I right, Peter? Is that what it is? 65-minute charts?
I think so, and I think it's because the trading day starts on the half hour.
Yeah.
And so if you use hour charts, you end up with like the last candle's only half hour. I guess the first candle's only half hour. Something like that.
So I heard something about that too, but see, for me, I'm a very simple, old school guy. I believe in simple timeframes that doesn't deviate much from my methodology. So for me, I'm okay with just that, right? You can even go up to 12 months if you want here, by the way. And then there's also ranges that you can add. Okay, but very quickly, that's one thing. Next up, there are some indicators that I would like to share with you guys. For those of you that are new to moving averages, you might want to look at this one. It's called Schema by Pattern Smart. Sorry, just type Pattern Smart. Okay, and it's this one. It's swing high support and swing high, low support and resistance. This is a pretty good one. It allows you to automatically choose what kind of EMAs you want. Okay, as exponential moving averages. Now there's a reason why we use exponential over simple and what is the in between one? It's mixed. It's a mixed one basically, right? There's exponential, there's simple, and then there is, I forget what's the last one. It's a mix between both of them, right? And this is a good one to have moving averages plot for you, all in one chart, all in one indicator, instead of you adding them individually, right? I like this one the most. So like for me, I use the 50, the 150, and the 200, right? Those are my 3 preferred moving averages. Everybody's different. Don't ask me what's better or what's worse. Let me just tell you that I use moving averages so sparingly at this point in my trading career. It's not even a part of my decision-making process, okay? It's one of the few things that I look at, and when I do look at it, it's after a very long time, just to assess how far we are away from moving averages. Like for example, you would be able to see that on SPX, we would be pretty far away from moving averages, right? Here, right? We're pretty far away from the 50 moving average. So at some point of time, the S&P 500, as the moving averages get higher and higher and higher, it will come back down to correct downward at the 50 moving average. That will happen at some point in time, right? But right now, that doesn't say anything, right? The market can keep ripping higher, right? We've seen how far, look at the previous time, right? How far we were above the moving average, and we kept going, right? We kept going. The same thing can happen here, okay? So there's really no point trying to guess which moving average is the best, okay? Next, visible range, VRVP. Visible range volume profile. This gives you volume, not only this way, which is date based, it gives you volume per price level. Okay, this is an important one to create some confluence, which is a mixture of levels in which you can see where majority of price action interacts. Your job here is not to figure out whether the volume was bullish or bearish. That is an impossible task to do. Okay, once again, for those of you that don't know, volume doesn't tell you whether something was bullish or bearish, right? For those of you that don't know, when something is green, when the volume bar is green like this, right, it doesn't mean it's bullish. It's just taking on the color of the candlestick above it. For those of you that don't know this, okay, I'm just mentioning it because it's something that you should know. And the same goes with volume on the sideways. Yes, it does tell you this is volume up or volume down, right? You can see value area up, value area down. But I wouldn't rely on it too much. Your main focus of using this should be to understand that this is an area which it becomes a key pivot point. It can either reject or break this level and validate it. Okay? That is a level that you have to now watch carefully. That is it. You can also make your row sizes bigger to give you more information, right? For example, you change the row sizes to 200. Now you have a specific point instead of it being one big fat bar, right? So these are quick, like little tips that I wanted to share with you guys. Okay. VWAP. This is a good day trading indicator. The only day trading indicator that I will actually endorse and ask you guys to learn for intraday price action. The VWAP indicator is the only non-lagging indicator. It is a leading indicator because it shows you live where the potential success for accumulation and distribution happens on an institutional level daily. Okay. Now, more on this can be learned. If you want to learn more about it, you can look up the internet. If not, there is also the GIT course that can teach you everything in totality. Okay, it goes through every single thing. Next one, volume, right? Not this one, not this one, not this one, not this one. Just regular volume, right? That should come below here. And a quick tip about volume: you want to put up a volume moving average. Okay, under style, you should change the volume moving average. The volume moving average will create a line, okay? And you should use an area graph, and you can change the opacity of this area graph to kind of show the volume or not show it. I like to show it just a little bit like this, right? Now, why do we do this? And the moving average length can be 9. That means 9 of whatever period you're in, right? The reason why we do this is because then at that specific range that you're looking at, right here, for example, you can tell if the volume was above average, below average, or at average. So down here, you can see, right, that when volume peaks out of the moving average, right, that is above average volume. That means at this point, there were a lot of interactions between buyers and sellers. All right. And a very quick lesson about volume, because we will be talking about this later, but I want to just kind of give you guys, actually, you know what, I'll talk about it later because it's going to gel with candlesticks. So never mind, that's okay. So this is one little aspect. Okay. Now, apart from this, you don't need anything else. Zero. You want to mature as a trader? This is what I'm telling you. You use your MACDs and your RSIs, you're going to get yourself into trouble. Okay. Now, I know many of you will have opposing beliefs to mine, and that's cool. This is my bias. This is my belief. This is my lesson after 11 years I'm sharing with you. RSI will tend to keep you in a trade longer than you should. RSI will also create urgency for you to get out of a trade when you shouldn't. It will create severe loss aversion. MACD will fire off false signals. I have been through those. If truly let me just ask you a very simple question. If you think that RSI and MACD were truly profitable strategies, then why isn't everyone a millionaire? It's available, right? It's available to everybody. There should be a lot more millionaires made from trading using these strategies, right? The truth is that they work only in certain aspects. They will not, it's not a one-size-fits-all indicator. And that's the reason why I say avoid them, because they're going to get you into trouble, okay? The one that you want to learn is VWAP. VWAP is actually a legit indicator for day trading because it shows you live what's happening. The VWAP that presents itself is a upper bound, middle bound, lower bound. Between those three, if anything deviates from there, you just need to know how to use it. You will be able to capture a very good portion of understanding where the volume weighted average price is for the day. Okay. Next. Toolbars. You guys see this thing down here? This is clutch. This is a very important thing to have. How do you activate it? There's a little star thing. You see it here? This star. If you have that star on, it'll show you the toolbar. You can move the toolbar wherever you want. How do you put things in the toolbar? Go to this thing, wherever the thing is, and add the star. Then everything goes into the toolbar. Right? Simple. So I want a trend line in there. I'll click the trend line. You see the trend line appears. Right? And then I can move the trend line, make it here, right? I can move it to the front, whatever, right? You get the point, right? Now, what are the most common tools that I use? I use parallel channels. This is for exactly what it means, right? Parallel channels, right? What does that mean? So I know some of you might be doing this from the time to time. You might draw this, and then you go and you draw another one, and then you go like this, right? Why do you do that when there's a parallel channel? You can literally do one, right? Go like this, and then do that, right? Much more effective, and it helps you line things up more perfectly. If you didn't know that exists, I'm just showing it to you. Trend lines, normal trend lines, boxes. This is helpful for supply and demand plotting, right? So for example, I go into Tesla, right? I know that on the broader time frame, right? If I go and pull up, how do I draw my my supply and demand here? Where's my here? If I go into the bigger time frame on Tesla and I see, okay, well, here I have a bunch of volume here, I have a bunch of volume here, I have a bunch of volume here, here, right? What of these points are in confluence with my support and resistance levels? What candlesticks paints me the story to tell this, right? So if I were to just go and draw this here, it's not really going to give me much information, right? If I were to just go and plot this here, it's not going to give me much information, or here, but I still have those levels, right? But you see down here is where a tremendous amount of volume came out of nowhere. And we went past that level and came back that level too. This becomes a clear level of demand, right? Below this level is a clear level of demand. So that's where boxes come in handy. I drew a little box here to tell me that at this level, there is some spooky demand that comes in, right? Okay, let's see. Are there other leading indicators besides volume and VWAP? Volume is not a leading indicator. Only VWAP is a leading indicator. No, there are none. Only VWAP. What indicators would you suggest for swing trading? Okay, these questions are asked, I will answer later. It's going to take away time from you. Isn't that like Bollinger Bands? Which one? VWAP? No. Bollinger Bands are different from VWAP because they take into account volume. Bollinger Bands will give you the range of where it's kind of stretching out. And it's volume weighted. It's not just volume. How do you use it? What are yellows and blues? Mac, I think you need to go and look at the volume VRVP indicator. You can see the style here. It'll show you exactly what it is about. Okay, all these questions I'll answer later. I don't want to deviate away from what we're doing right now. So I will answer a lot of these questions later. Just stay behind after the bootcamp is over. I will answer your questions, okay? You can ask whatever you want at that point. So The boxes are helpful for plotting supply and demand zone. So let's do one together, right? Somebody give me a random ticker, something that I've probably not plotted before. I don't know. Give me something random. So it seems Z-scalar maybe. Right on Z-scalar, yeah. Yeah, okay, so this one, right? I haven't done this yet. Okay. Netflix, okay, two people said Netflix. Let's see Netflix. All right. So Netflix, for example. Now on this time frame, first of all of you know, when you're doing a new analysis, just remove everything. Start afresh. Okay, start afresh. This is where you get your bare bones, right? Now, how do you accurately draw supply and demand? How do you figure that shit out, right? Very simple technique, actually. First of all, start by plotting all of the extreme points on the chart. What does that mean? I want you to plot the extreme bottom, which is somewhere here, right? And by the way, one important thing, because I know you guys can be like very specific about this. What if there's a point here, and then what if there's a point here? What are you going to do? You use the point where you have at least two confluences, 2 points at which you touch. That's the how a trend line is validated. Okay, 2 or more points. Okay, and then what do you do after that? You find the next 2 points. All right, here is it here? Yeah, there's one here, right? Boom, right? Okay. This now shows you a range, correct? This is where your range was, right? Now put in your volume, right? Okay, looking a bit interesting, right? So do you realize something? There's a bunch of volume that came in this range. There's a bunch of volume that came in here too, right? But here on the bottom, these two spots right here, right? It's too far back. It's too far back in history. This is 2016, 17. Remember that when you are charting, chart intentionally. What does that mean? You are charting with the most recent price action in your back of the head, right? Now, I just want to show you how to draw the demand zone here, and then I'm going to show you how to draw the demand zone higher as well. We're going to do a little exercise together, okay? And I'm going to do one example, and then after that, that's going to be for you guys to practice on your own, okay? So what is this now? This symbolizes a box, right? Well, this could be a potential demand zone, right? Remember, I said potential, right? And you can change the color of that box if you want, right? For me, I have specific colors that I use, like demand becomes green and like supply becomes red, right? So now you have other levels up here too, right? Now this level is too far down. It's not relative to the price that where we are at. What about here, right? Well, we need to find something within that time frame. So now you've got to scale down to a different time frame, 4 hour, right? Go into a smaller time frame now. And that VRVP needs to come back. There we go. Okay. And find where the confluence point is, right? You can see there's a bunch here, right? So now, next one. A bunch of supports right here, right? You see that? Here, here. This is support turn resistance. Another support here. This became resistance. This became a gap. This is another support here, right? You know that there's a level there that you need to be aware of, right? This is where demand comes in, correct? And what about higher than that, right? There is also another point. You see it? Do you see it? Do you see it? Bam, right there, right? See that? Demand came in here, demand came in here, here, here. All of these points, right? These are all points. Also here, right? So this becomes a higher demand. Now, this is what we call a local demand. A local demand means it's in the region or the range in which you are trading, right? So this is your immediate liquidity provider. When you're long here and there's no more liquidity, this is where prices are likely to come down to. Now, what about supply? There is also supply, right? So you had a price up here, you had a lower price down here, right? 2 points. This also here. There's also some down here, right? Potentially, right? So there are actually 2 levels of supply here. There's one more here. These 2 zones are your supply zones. What are they supplying? They're supplying liquidity. Okay. What are these demanding? They're demanding liquidity. Always remember, think in that perspective. Now, I'm teaching you this method because it's like the TradingView method. It's like you can't look at these levels just right off the bat if you're a beginner because you're not trained to it. Now, this is after 11 years where like I look at the chart and I look at it and okay, I know exactly what to look at, right? But some of you might be new to this and I'm teaching you how to do it in a way that is repeatable for you, where you can understand that, okay, there's a methodology to this, right? Well, the reason why I'm pulling out the levels that are extremes is because these are the levels at which price action are confluencing with key levels, right? So you can see that the volume here intermingles with this level here. This is a clear demand area, right? And there been a lot of price action here that got bought up, right? So you can even move it down to reflect that, okay? You can move these things around. It doesn't need to be static, okay? So this whole area becomes an area in which I want to watch closely for potential buying, correct? This will be support level. And then this level over here above is where this will likely see some resistance, some selling, right? So now this becomes red, for example, right? So now I know, okay, these are where in this chart, this is where I need to be aware of, right? Now, above this, over here as well, there is some selling here. So maybe I don't need an entire zone for this, right? I don't need an entire zone for this. So what do I need? Maybe I just need a red line, right? Your trading, I mean, your style of marking can be very, very specific to your own things, right? Okay, it's not an entire zone, but it's a line, it's a point, right? Where you need to be aware of because there was a past resistance at this level. Okay. All right. So now you have all of this plot out. Now what? Right? Now what? So since you guys talked about Netflix, let's do Netflix, right? So now remember, when did I start? I started on the daily time frame. Where am I at now? 4-hour time frame. What is this called? What kind of analysis is this called? It's called a top-down analysis. Whenever you are doing an analysis of any chart, you have to start from the biggest time frame that you are going to look at and then move down into the smaller time frame. So if you are a swing trader, you probably live around the 1-hour time frame, but then your entries and exits will be determined on a 15-minute time frame, right? And if you're a day trader, then you're probably looking at a 1-hour time frame, but your entries and exits are probably determined on a 5-minute time frame. You see, it all changes based on what you're trying to achieve, correct? So you have to be aware of this. Does everybody follow me so far? Any questions? No questions? Okay, continuing on. All right, now you have your supply and demand plot out. You have a big demand level here, which was way below. The price level is too far away from where you were, so you created a new demand here. This is your local demand now. This is where price action is likely to come back down to if Netflix doesn't move up into the supply, right? So there is all of this supply that can be gotten where more supply can come in and then push the price down. But right now, because bulls are in control of the market, they have been pushing the price further higher, right? So how do we determine this now to try and create a trading plan around this scenario? We need to move down into a smaller time frame, first of all, right? And first look at what is going on here. Okay, so we go into the 1-hour time frame first and have a look, right? First of all, what kind of a trend is this? Are we in an uptrend, a downtrend, or a sideways trend? Quickly. I see you there, Jenny. Uptrend, right? Now, if you're in an uptrend, then very simply, let your chart tell you that it's in an uptrend. How do you do that? Let's draw a parallel channel, right? First, that's the first step, right? Can we draw a parallel channel on this? Do we have 2 points of confluence? We potentially do, right? Okay. Now, sometimes this may happen, right? This is the point out here, but can we use this point? We can't. Why? Because there is no 2 points touching it. Remember the rule, right? So you need to find the next 2 points that touch. Move it down, 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 move it down. Ah! Wait a minute. Winner, chicken dinner. Now extend this out, right? Okay. Now, some of you might be thinking or asking me, T, what about this? What about this? What are those? Why are they there? How does that play into my analysis? Those are what we call fake outs, right? Price action is not always going to be pretty, and it's not always going to be perfect. There are levels at which market makers will push price up into to grab some of that level and then push it back down so that they can create more buying pressure later on. And you can see exactly that happen. What is this level? The red line that I marked, that was a key level of what? Supply. Right? Did you not hear me say it earlier? This was a key level which supply was waiting for, right? When it touched this level, it waited about a couple of hours and then it sold down the next day, right? There was no event down here. You can see there was no specific event that happened, but Netflix got sold off and there was also a gap, and this is a very specific gap. This is called the exhaustion gap. Okay, we're not going to get into that right now, but now that you know the trend is this way, you can start to do an analysis of what the key levels are now from here. Okay, next level now. Okay, we need to look at here. There's another key level. Now this is not red, but this is going to be yellow, right? This is a key level. Okay, what do I mean by key level? A key level is a level at which it becomes a pivot point, right? It can go bullish or bearish from there. And the next few levels, you need to start plotting them out, right? Okay, what else is there? Here, not really. Here, there is some, not really. There is another key level right here, potentially, right? There's a key level here. They got some buying. Actually, it's a little lower than this, I would argue to say, probably here, right? There's a key level right here, right? And then the next key level is down here, and the next key level is down here, right? So there's another key level down. A little lower. There, right? Why am I choosing these points, right? This is where demand came in, demand got bought up, demand came in, right? And resistance. This is a dual zone, okay? This level here, there was a bunch of selling, and then selling and buying, right? This level here, there was some buying. So these levels are key levels. Now you have key levels. Remember, alternatively, if you don't want to use this and you know how to use Fibonacci's, you can also use that method, right? You can also use that method. But remember, with Fibonacci's, you need to have a bias, right? You need to have a bias. So you need to have a directional bias with Fibonacci's. That means your trading plan with the Fibonacci needs to have a back perception of, am I looking for a bullish trade here or a bearish trade here? Because Fibonacci's are intentionally designed to give you targets for both sides. So you need to know what kind of a target you're looking for. You cannot be aimless with a Fibonacci. That's how people get it wrong with fibs. When you use fibs with no direction, you are basically aimless at that point, right? It does give you key levels, but if you use it unintentionally, it's not going to help you, okay? So I like to use this better because it's just simpler for you to understand. Okay, so now you have some key levels here. And remember, above here, there are very few key levels, right? In fact, I would argue to say probably above here is very thin volume as well, right? Probably very thin volume. Let me see if I'm right. Yeah, I'm probably right? There's very little volume here, guys. Look. And we know what happens when there's a low volume scenario. It's like a vacuum, right? It pulls price to that level, okay? So very simply now, you can come up with a trading plan, right? Now, obviously, I'm doing this with you, and that's the reason why it's taking so long. I'm explaining everything along the way. I'm giving you full explanation. But in reality, if you're a seasoned trader and you're doing this, realistically, this is going to take you about 15, 20 minutes, right? Max, okay? And this is what you have to spend the time on the weekend doing. The problem is, y'all look at way too many charts. Y'all look at like 15 charts, and then by the time you're done doing this, you're like, you know what, I'm exhausted. You have decision paralysis. You don't even know which one to look for, right? I say pick three. Pick three stocks that you really love and focus on those first. Get really good at them. And then you can explore other things, right? You know, I have done this for years and years, and charting becomes second nature like this, like the way that I'm doing it. Then you can do these things quickly. But if you are in the beginner stage and you are like, oh, I need to look at this and this and this and this and the MACD and the RSI and the volume and this and that, by the time you're done, you don't even know what you're looking at. Your chart looks so messy, right? So how do we trade this now? How do we come up with a trading idea for this scenario here, right? That's the next thing, right? Because the whole purpose of doing this exercise with you guys is to teach you how to use TradingView so it's intentional and you are creating trading plans out of your TradingView. So you have obviously a level of demand here, you have a level of supply here. And right now, Netflix is moving further towards the level of demand, right? If Netflix moves further down into 596, right? That would be a break of structure, right? And would enter a downtrend. Does that mean I'm going to go short right away? If we break this level here, does that mean I'm going to enter short on Netflix right away? Is my question.
No.
No, because you do not have confirmation. And one of these can happen. It can be a fake breakdown. So you need a rule of engagement for validation here, right? What do you need? You need a break below 596. You need a retest of 596 or higher. It's not always going to be perfectly 596. It might be 600. It might be 610. It might be 647. It might be even at this level perfectly and then reject again, right? There are so many scenarios that can happen here, but you need a plan. A change and break in structure, which right now this is showing up as a bear flag, right? Means that the price action will break further down, it will retest and validate this new level as a lower high. That is how a lower structure is formed. When you have higher highs and higher lows and higher highs and higher lows and higher highs and higher lows, that's an uptrend. When you have lower highs and lower lows and lower highs and lower lows and lower highs and lower lows, that is a downtrend, right? And right now, you don't have that confirmation yet, right? You only have a low. You need this to bounce back. You need this to do this. You need this to do this. You need this and this. And there's a long way to go, right? So the trading plan here is, in order for you to have a short bias, you need Netflix to break 596-ish. What are you going to do? This horizontal line, you can add an alert to it. Add alert. Okay? This alert thing will come out. Now, there are two ways to do it. The one way is, if you are able to remember your trading plan, which for me, I have very few of them, therefore I remember most of them, you just set your alert. Now, I know what I'm looking for here. If Netflix breaks, I revisit the chart. I know the entry is good. Then comes a next level of confluence, which is what? Observing the options chain. I need to look at the right contracts to trade, right? There's a whole layer to this, right? And majority of you just get hung up on the charting. There's a whole other aspect to this, which is derivatives, right? So the first part of this is getting this part right. You see there's a message down here? Type a message to your future self. Hi, T. When Netflix breaks down below 596. Now, okay, I'm really exaggerating here. This is not what I do. But if you want to see what I do, I just do this. I just do below 596 with retest. Sure. Right? And then bounce 596 equals potential long with volume. This is just a mental note for myself, right? Now, and by the way, here's a good one, okay? You can also do it two ways. This is one way, right? The one way is the alert goes off for both scenarios. The second way is you have two different alerts for two scenarios. Here's what I mean. So you first do the short one, okay? Needs to retest it, right? So it needs to come down, break this, and then retest. And then you do a bounce case scenario. What is the bounce case scenario? You do another line, or you can do another level, which is like this level here, 600, right? And you add an alert here, okay? And here, you do bounce 596, potential long. And here's the beauty of this. Instead of crossing, just crossing, you put crossing up. This way you know that if Netflix came down to 596, alerted you, and then you get a second alert, that's your entry for long. You see what I mean here? It's about setting your alerts intentionally. Now, my downside and bounce scenario is covered, right? It's covered. I've done the work. Now I just sit here, wait. I just wait here, right? This is the thing about trading. The toughest part is the waiting and being patient, and then seeing your plan come into play, and then executing to perfection. This is the tough part. Okay. But it all comes with prep work. You realize how much work goes into this. It's prep work, right? So there's a lot of things that go into the emotional part, the technical part, yada, yada, yada. Right? You get what I mean. So this key pivot point is the nearest one that you're likely to interact with. But then, what if you go break this key pivot point here? Then you're going up to 634, right? So now you need another alert, another set of alerts that are coming here, right? So let's move this slightly higher to reflect a better point like here, right? And now this becomes a next alert, right? 622 rejection equals short entry, right? And then what else? That's a short entry, right? But what about if it does this, right? So there also, by the way, this scenario, there's other ways that this can work, right? So it can go like this, and then it can come down, right? And then go for the high. Or it can go like this, and then down, and then this, and then that, right? So you need to reassess when it comes up to here is what I'm saying, right? So you have this one that will alert you when Netflix is breaking this. But what about if it fails to break this and comes back down? Then you should be ready to grab a long entry, correct? So you need to set another alert slightly below it, right? Right there. And this one becomes Netflix bounce here equals long. Okay, now you have some alerts up. Now, I don't always put these notes there because I just know the key levels and I know exactly what I'm looking at. But as a beginner, you should be writing these things down because there's no way you remember all of them. Okay. I have a very few things that I look at, therefore I set alerts just by right-clicking, alerting, but I set them intentionally by making sure that it's a down crossing. Oh, sorry, one second. This one was a crossing up one, right? This alert, the second one that I made, is a crossing up alert. Why? Because it's gonna come down and then cross up above it, right? So that's what we want there. So now you have both sides of this plan set up, right? Okay. Now, when you are at this point, your risk to reward ratio is going to favor the downside. When you're at this point, your risk to reward ratio is going to favor the upside. So you need to be aware that besides the fact that you're planning your trade here, you have also the responsibility to understand that these two trades have a different trading outcome and different risk to reward ratio outcome. Okay. So this is an example of how you can use TradingView intentionally, set alerts intentionally. Okay. Now the rest of this stuff is mumbo jumbo. You can play around with it, text boxes. By the way, also another thing you can do, which I think I've seen Peter do this before. Peter, I know you put text boxes up here, right? What do you use? You use
I just use the little letter T there down on your toolbar, drawing.
This one, right? Yeah. I don't know.
Yep.
Yeah, this. So you can do Netflix, bounce, reject, levels, blah, 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 blah. You can write a note to yourself and you can put this right here, right? You can make it bigger too, right? You can make it big and write your notes here. It's in front of you. You can't go wrong if it's in front of you, right? Put things on your chart. Now, I don't put things on my chart because there are 5 other people using it. Now, actually, you know what? I'm going to start doing that because I don't care if you guys can see it. In fact, it might help you guys. So the mods will pretty much have access to my thoughts at this point, right? Which would be nice. But yes, you can use that as a proxy to your thoughts, right? You should write it down, and that way it's in front of you. You don't mess up, okay?
Also, if there's a fundamental component to the trade, or if there's nuanced information that plays a part in the trade plan, I put it there to remind myself because you know my memory lapses sometimes.
Yeah.
And it jogs it.
I know for a fact that Andrew also puts gamma levels on there. He puts delta levels on there. He puts the levels of where there's buying pressure, selling pressure. That's another way to do it, right? There are many different ways. As I told you guys, my way is not the gospel truth. I'm just showing you an easy way for you to get started, right? And this is a very simple way for you to do your charting intentionally. The main thing I wanted to show you in this process was the alerts. The alerts are very important because if you put your alerts properly, and you stagger them with the right intervals and you do the right settings for them, crossing up, crossing down in a certain way, you barely have to watch the chart. When the alert pops up, that's when you go in and you're like, okay, I'm ready to take the trade. And you should give yourself time with those alerts to give yourself a little bit of room so that you have enough time to go and observe the option chain before you take the trade. So I would, wherever your alert is, place it a little below or higher so that you have time after the alert goes off to go into your broker, go to the ticker, go to the option chain, and then comes the whole process of selecting the right option to trade, right? Because you need to know the right strike price, the right expiry, all those things, right? Okay. So now I know I can go on further with TradingView, but let's stop there for now. Let's take a 5-minute break and then come back later with the next portion of this class. Very quickly, right before you go, I was offering this to the beautiful Discord members, and this is, I'm opening it up to everybody who's not a part of the beautiful community. The Everyday Growth Advisors Growth Investing and Trading course is 50% off for the next 48 hours. If you're interested, you can use the coupon code 50OFF. What you will master: risk management, building a diversified portfolio. That means you'll learn how to value your own stocks using the DCF method. You'll be given a DCF template. You'll understand the basics of the stock market, technical analysis, full deep dive, options trading, full deep dive. There's over 120 lessons, lifetime access, and that's what it will come with. So you'll get 50% off this if you use 50 off on the coupon code. Okay. Where can you sign up? I will leave the link in the chat. If you're interested, you can go and have a look. No obligations whatsoever. I just wanted to put it out there that this is a 48-hour sale that we are going to be launching. There you go. All right, go take a break. We come back in about 5-10 minutes, and then we're going to run through a couple of other things. Guys, today's workshop's going to drag a bit longer, so I hope you don't mind. I almost forgot to continue recording. Candlesticks are a very simple analysis tool that you can use to analyze supply and demand in a security, but it is not the full story. Okay. Individual candlesticks can tell a story on a bigger time frame. A weekly candlestick will give you a lot more information than a 1 hour, 15-minute, etc. And a combination of form of candlesticks that are small to medium term will tell a story for a smaller time frame. So knowing the difference between time frames will ultimately help you master candlesticks, and it helps you to visualize momentum and the force of bulls and bears. So in this chart here, I just want you to understand that the more stronger the body of the candlestick, the more stronger the side is winning, right? So this is less stronger, less stronger, less. This is almost not the least strong, and then this is neutral, where you have a very thin body and a lot of tails. This is what we call a doji. This is an indecision candle. Okay, and then goes bearish from here. This is the opposite. Now, I know a lot of you would have seen 1,000 setups for candlesticks, but I'm just going to tell you that there are very few that you need to pay attention to. And the two that you need to pay attention to are pin bars and engulfing candles. After 11 years of doing this, the two most insightful ones are pin bars and engulfing candles. Okay, focus on those two. They'll give you the best approach to finding opportunities. What are pin bars? They are simply candlesticks with a long lower shadow, or wick as we call them, and a small body. Okay, and both bullish and bearish. And this is a high probability signal that there is going to be a short-term correction in the opposite direction. So there will be a reverse and then continue moving along the way of the long-term trend. And this is only valid when it cuts the support moving supply demand. Okay, So let me give you the idea here. You can have a level of demand, a demand zone, if you will, right? Which we were talking about earlier. The pin bar is only going to be valid if it tries to attempt to break and fails to break, and then closes back above that range. Okay. The second thing is, once you have seen this, this is not your entry signal, because it can still continue going further down. What you need to wait for is for this trend to be invalidated. And how does that happen? That means that the next candlestick closes above this candlestick here. Okay. It can come down and have a wick down here, but the body of it needs to close above the previous candlestick. This is where the trend is now kind of validated. Okay. And this can be on a 1 hour time frame, it would be a pretty strong signal. On a 15-minute time frame, less strong of a signal. Okay. The same thing goes for here. You have a price action coming up, the rejection happens. The entry is only when the body of the candlestick closes below this candlestick here. Okay, it can have a long shadow, it can have a long wick, whatever, but the body needs to close below. Okay, that means that price action is moving further lower. Okay, very simple rules for validation for pin bar. Engulfing candles are a similar setup, except for they don't always come with pin bars. It might be a random candlestick pattern, right? It could be a doji, it could be a normal candlestick, it could be a pin bar, it could be anything. But the rule of engagement here is that the body of the second candle engulfs the previous candlestick. What does that mean? You see the body of this candlestick? It's fully covered. That's what engulfing means. It's fully covered by the previous candlestick. Okay, so when this happens, this is typically a good sign that the trend is about to reverse, and you can find your entry at any time after this candlestick, right? After this candlestick here. Okay. So once again, 1 hour time frame, not probably stronger than the 15-minute time frame, and the reverse happens for a bearish engulfing candle where the body is the same. Now, one thing to note: sometimes you'll get the body lining up perfectly like this. That is also still a valid engulfing candle. Okay, as long as the body is lined up and it's engulfing the candle before it, that is a valid engulfing setup. And your entry can be either at this candlestick or the next one. Okay. So the next candlestick here. All right. Now, other things that you need to understand is that there are also doji candles that can be paired with this. The doji can appear here, right? Or you could also get a double top, double bottom scenario, which will have a rejection or a support twice before moving into the intended pathway. This also comes with another scenario where you have a double top like that, right? And that would mean that the range is broken after 2 times of failed breakdown or break up. Okay. Now, volume. How do we understand volume with correlation to candlesticks? The most important thing here to note is that a strong trend, okay, is accompanied by strong volume and strong directional bias. Okay, so when you look at something and the volume is high, but the price action is moving. So if price is moving up and volume is moving up, this is a strong trend. If price is moving up, but volume is low, then this is a weak trend. The converse can be spoken about a downward price action movement. If price is moving down and volume is strong and moving up, this is a strong downtrend. If price is moving down, but volume is also down and low, this is a weak movement. Why is this so? This is a cheat sheet, obviously, but why is this so? See, it's very important that I don't just give you this cheat sheet, but also explain to you why this is so. When you are looking at volume, you are typically looking at interactions of all buyers and sellers. Okay? And when you're looking at all interactions of the buyers and sellers, it's very difficult for you to weed out whether buyers were stronger or sellers were stronger. However, what determines that whether buyers or sellers were stronger? It's the price that moves, right? So if price is moving up, what does that mean? That means that there are a lot of buyers, correct? But because volume is moving up as well, that means that the price is increasing with a lot of buyers and sellers. Now, we don't know the fraction. We don't know what amount of buyers or sellers. But what we do know is that there are a lot of buyers and sellers. That forms a strong trend. Why? Because the price is moving up with a lot of people interacting. That means for every buyer, there's a seller. For every buyer, there's a seller. For every buyer, there's a seller. Remember how a trade works. A trade only goes through when if you want to buy, there's somebody to sell you something, correct? You can't just buy without anyone selling you something. So when price moves up, that means the quantity that is bought is high, correct? But what happens when price moves up and volume is low? This means that there are only buyers. And this is a dangerous scenario because when there are only buyers, what happens when sellers step in after the price action is completed? A reversal can appear, right? A rug pull can happen. Because what happens now? There is a mini capitulation scenario. If all buyers have bought and there was no sellers to contend, then at the end of that price action, when sellers step in, there will be no buyers left to buy, leading to a reversal in price action. So understand this about supply and demand, okay? To put this in perspective, the same thing happens in a negative or a bearish scenario, right? Negative price action. When price is moving down and volume is very strong, that means that there was a buyer at every level for every selling, right? There were a lot of buyers and sellers. That's a strong downtrend because there are equal parts of the market, right? Each part is validated. That's a strong trend. But if their price is moving down and volume is low, what does that mean? What does that mean? Someone tell me.
Is it more sellers than buyers?
Exactly. There were probably more sellers than buyers. And this is dangerous. Why? Because now, at the end of that trend, when that selling is over, when buyers step in and they all step in at once, the price can rebound very quickly. This is why you need to understand volume. When volume is low, avoid trading frequently. When volume is high and momentum is high, then you can trade and you can have better entries and exits. Now, what also happens when volume is high? What other thing happens? Can someone tell me? When volume is high, there are more buyers and sellers, correct? What does that lead to? That leads to higher liquidity environment. That means that every seller who wants to sell will get a selling exit. Every buyer who wants to buy will have a buying exit. That means that your spread, the difference between the buying and the selling price, becomes smaller. As a trader, you want spreads to be as small as possible. You remember the bid and the ask? We want the bid and the ask to be as slim as possible. And that only happens when volume is high. Because when volume is high, everybody is willing to line up and pay equal prices within a very small spread. If volume is low, then the spread becomes bigger. And the reason why I'm telling you this is because from the stock price perspective, it's important, but from the derivative perspective, that means the options trading perspective, it's even more important. Because when you have strong volume and equities trading, that affects the derivative pricing as well. So more importantly than looking at the price of the stock, you should also be looking at the bid-ask price of the spread for the derivative, the options that you're looking at. And so when volume is higher, you will get more efficient entries, more efficient exits, and you will get better pricing mechanism. Okay? Very simple theory, very simple application. Does everybody understand? If you understand, say I understand. So now I can move on from this. Okay, great. Next, Some order execution tips. As I mentioned before, always set a stop loss for your trades, right? This defines the risk of a trade and it locks in reward in relation. If you stopped out, you followed the plan. This is not a bad thing. People always look at stop losses as a negative thing. Change your mindset. If something hit a stop loss, if you have followed your plan, you don't need to behave negatively about it. And you don't re-enter the position until you see further confirmation. A lot of you get stopped out and then you're like, oh no, market makers it stopped me out, so therefore I'm going to re-enter again. And then you double your risk position. Before you know it, without any confirmation, you have doubled your risk with no proper confirmation and you end up losing the amount, right? Then what takes over? Sunk cost fallacy takes over, right? Now I put in too much. Now I need to win back this money, right? So you can see your initial decision, don't move the goalpost, okay? Whenever you are in profits, move your stop loss to break even. And then for profit, you leave your runners to maximize rewards. Anyone who's in my Discord knows that this is my methodology. The moment I hit 20%, the moment I hit 30%, I am taking profits. Let me show you there. Right? So look at my P&L summary from the year before, right? Where are my frequency of gains? This is my entire trading journal for the year. Look at where all my profits have taken. Between 20 to 40%. These are all runners. These are all losers. Look at the proportion of my winners to my losers. These are all wins here. Where do they all occur? Between 20 to 40%. I'm not giving you duda. I'm not giving you information that I don't practice myself. This is what keeps me profitable. The consistency of taking profits at 20 to 40% is what's going to keep you in the game. All right. If you're going to keep hitting, yeah, of course, like there are some times when this happens too, right? Don't get me wrong. There are some winners at 200, 160, 140, 120, 180, 60, whatever. But are there a lot? No. Do I bank on them? No. I bank on these because taking profits consistently is so much more important. Okay. Very, very important. Now, if you do this correctly, what's going to happen is that you're going to have runners which will pay out more than your initial projected RR. So let me show you kind of what this looks like, okay? And by the way, just to complete this before I show you the example here is the reason why you get stopped out is not because a market maker is trying to stop you out, just so you know. About 70% of the time, and I'm throwing 70% very loosely here, 70% of the time, it's because you had an incorrect entry. But you blame it on a market maker because of why? Ego, right? It's actually not the market maker. It's actually your incorrect positioning. Now, let me show you an example of this, right? Let's say you have a range trade that has formed, right? A range. You have your supply zone up here, your demand zone down here, right? And you're thinking, okay, you know what? I'm going to wait for the breakout and the retest, and then I'm going to play this, right? Some of you, what do? Okay, for a rational trader, if you've been in this long game, then you know I'm going to wait for the retest after the breakout, and this is where I'm going to enter long. That will lead to gains, right? And then I'll show you how to manage your stop losses after that, right? But the main thing here is some of you enter your longs right here. How many of you do this? There is no wrong thing in doing this. I just want you to admit how many of you do this, where you enter the breakout. How many of you do it? It's not wrong, once again, okay? Now, the reason why a lot of you get clapped by entering into this scenario here is because where are you entering it? You're entering it at an exhaustion of a long wave, right? And the wave is at the point where it is breaking out of a previous resistance. Yes, I get that, right? But more importantly, at this point, liquidity is running low. Don't get me wrong, the trade can keep running, but at some point of time, it needs to pull back. There is absolutely no reason for you to take this trade long here when you have this much of risk on the table. The reason why you're doing this is because you are giving into your emotions. There's nothing wrong about it. All I'm telling you is be aware that this is not always going to work out in the way that you think it's going to work out. Okay? When you take the trade here, the risk to reward ratio that you're taking on, if let's say this is the next level of resistance, right? This is your reward and this is your risk. If that doesn't speak volumes about risk to reward ratio, I don't know what does. Now you can also argue to say, no, but T, I can just set my stop loss here. Okay, great plan. I got that, right? But do you know what happens? When you enter long here, you go up here, and then you fail to take profits. This is the problem. If you took the long here, and then you close out for profits here, here, and here, you know what? I respect you. It's cool. You played out your plan, right? The problem is some of you don't take profits, and then you know what happens? The market maker comes down and pushes you out, going below where your stop loss is. And then some of you decide to double down on the position after that. This is what gets you into hot soup. First of all, you followed the FOMO, then you didn't take profit, then you double down the risk. What do you expect to happen? Your account not to blow up? Should I give you candy to reward you? No, you're gonna F yourself big time if you keep doing this. So what is a better way to manage this? A better way is always to give the trade more time to play out, right? When you see the breakout, always wait for the run to happen. Wait for the run to happen. Wait for the pullback. And then find the signal entry on the bottom of the pullback. How do you find the signal bottom entry on the pullback? Somebody tell me. I just went through it. Reversal pattern. Look for the pin bar. Look for the engulfing. Look for the options, the unusual options trades that are being put in. Right? Wait for the bounce. Once you wait for the bounce, okay, now look at the difference here. Right? If you set your stop loss a little lower here, this is my stop loss, initial. This is my entry after a bounce, okay? E for entry, right? Now my risk to reward ratio is a bit better, right? Even though it's still 1:1, right? What you can do though, because your stop loss is here, right? Your risk to reward ratio will improve. You can control the stop loss, right? So the reason why it didn't work here versus here is because your entry was wrong. Because you entered here and then you didn't take profits and then you let the trade come down and you're like, I'm going to add more to this. And then it reverses altogether and goes the opposite direction. You're risking too much on the table. Your risk management was off. So how do you manage the trade after this? Okay, so let's say now there's two scenarios this plays out. The first scenario is the trade plays out in the way that you want it to play out, which is it reverses and bounces, right? So then we get a bounce. Or it goes bad, where it breaks down further. If it breaks down further, it hits your stop loss, you're out, you're done. Nothing to talk about further. Move on. However, if it bounces, then what do? The moment that you're in 20 to 40% profits, move your stop loss to break even. The moment you go higher, move your stop loss up. SL2. The moment it goes higher than that, keep moving your stop loss up. What are you doing here? This is locking in profits. Okay. Now, for me personally, once again, you don't need to follow my style. Okay. For me personally, the moment I hit 20-40%, I de-risk my position by either half to 3/4. Okay. Everybody knows I do this. I'm very notorious about this. I take profits very quickly because I don't believe in holding runners into oblivion. Then you let the balance position move. If it moves in your favor, you're going to make a lot of money from those balance positions. Those small positions can sometimes give you the profits that are more than your initial risk that you set up. I've had that happen to me many times. Okay. This is the strategy that you should use, because what happens here is your RR will get increased. Instead of an initial 1:2 risk to reward ratio that you were looking at, your runners from the balance position that you closed out could hit a 1:5, 1:8, right? And that's your beautiful moment where your risk positioning and your risk to reward ratio improves tremendously. Okay. Now, what about scaling in? This is another way to manage your positions, right? Scaling in is the strategy where you add more to your position when you get confirmation of a trend, right? You have a long, like the Netflix trade right now, you have that idea, right? And you have an uptrend. You have a confirmation. You open your position. Oh, another thing I forgot to mention. Sorry, going back. Sorry. Right before I do this first. Please, for the love of God and all things great in this world, please don't allocate all your capital in the first tranche of your position. Always break your position sizing into at least 1/3 or half. Half at the minimum. There is no rush to take all your position at once. I don't know why people have such a big urgency. No, I need to enter it at this price now. The price is going to fluctuate. It's going to come up and down so often. You don't need to rush into it. Until and unless you are scalping, there should be absolutely no reason why you enter everything at once. Okay? So please allocate your positions in tranches. So when you get confirmation of a trend, avoid entering the whole position at once. Enter allocation on dips. Here's what scaling out looks like. Scaling in looks like. You add your first allocation here. Price moves up, you move your stop loss, and you scale in additional. Your stop loss is now averaged higher. Why? Because your entry price is going to be higher. Why? Because you've added another position here. Then move your stop loss higher and do the same thing with the third. But when you are adding the third position, you have to take profits on the first allocation. This is very important. Okay. Lock in some of the gains from here, because this will add and give you the energy to allow the second position to play out. Many of you add without taking profits. And this is what really gets you in the pickle. Okay. So don't do that. Take the profits when you are at this position here, and then you can roll forward the contracts, or you can do anything else you want with that. Okay. So scaling in is a very simple strategy. The dangers of drawdowns. What happens when you don't manage your stop loss? And I think you guys have seen this chart before. If you lose 10% of your capital, let's say you took a risk of 10% and you lose the 10%, you only need 11% to gain back. 11% winning trade. If you lose 20% of your account, you need 25% of the same risk sizing to win your account back. Realize where the point of no return is. The point of no return is beyond 20%. Because getting a 40% trade is a bit unrealistic. 67% trade on your full capital is also unrealistic. Anything beyond this point is unrealistic. 25% is still clawable. This you can still rebound from with the Hail Mary. The moment you go point this line right here at 20%, you are almost destined to fail. This is the reason why losing your capital is an absolute no-no. You have to really control the bleed. If you are assigning 10% risk from your portfolio, you seriously need to rethink it, because it's a lot of risk. I personally stick with 5% maximum. And only if I have a high conviction trade and it's a leap position, which is like a share replacement, then I will add considerable amount of risk behind that position. So if I'm taking a long contract, like for example, I recently took IWM longs. You guys know about this. I mentioned it like 2 months back or 3 months back, something like that. Start of the year, right? No, maybe, sorry, February, I think, right? 2 months back? Yeah, 2 months back, right? So if I'm taking a position like that, I have the macro supporting my thesis. I have a trade idea behind it. I deposited money for that. Why? Because it represents shares. It represents equity, different. If you have the portfolio, your options portfolio, don't go and allocate too much risk, okay? And that's where I need to leave this lesson today. That's all I have for you guys today. I appreciate you guys tuning in. Now, once again, if you have questions, stay behind. If you have any comments, things you want to talk about, blah, 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 you can. I'm just going to leave this up here in case you want to see it for those of you that missed it. Also, I don't know if some of you missed access to the Discord. I'm going to paste that link right here again in the chat. Free access to Discord. You can get the free resources that you deserve. And of course, if you require a premium plan, yesterday I put out a 30% off coupon. You can do that. A couple of you signed up with that. I appreciate it. We'll see you on the trading floor. But you have access to me on the Discord. We will have a public trading chat room. You can ask questions, etc. there. So you can use this link to join the Discord, and that will also give you access to us. So the rest of you, anybody who doesn't want to stick around for Q&As, you can take your leave here. For those of you that want to stick around for Q&As, go ahead, post your questions. I'm going to end the recording here because it's about 2 hours already. And this will be uploaded on YouTube the same way and be sent out to the emails that you guys signed up with probably by the end of the day today. Okay. So thank you for tuning in for day 2. Do not miss day 3. It is very important. Okay. I'm just going to say that.